There is a secret 3-digit number that quietly decides how much your entire life costs. Your house, your car, your apartment, even your phone plan. And the people who invented this number never once sat you down and taught you the rules. Here's how insane it gets. Two people walk into the same bank and buy the exact same house for the exact same price. One of them will pay $94,000 more than the other over the life of that loan. Same house, same price. The only difference is this one number. Over the next few minutes, I'm going to hand you the rule book that most people never see, so that number starts working for you instead of quietly robbing you. That number is your credit score, and almost everything you've been told about it is either wrong or incomplete. Let's start with the basics, because they matter. Your score is a number between 300 and 850. The average American sits around 715, and here's the part that should make you a little angry. This score follows you everywhere. It decides whether you get approved for a mortgage, what interest rate you pay on a car, whether a landlord rents to you, sometimes even whether you get the job. A 3-digit number you were never taught to control is silently pricing your entire adult life. So let's fix that right now. Here is the rulebook, the actual formula, broken into 5 pieces. And once you see it, you'll understand exactly which moves matter and which ones are a waste of your time. The single biggest piece, 35% of your entire score, is payment history. Do you pay your bills on time? That's it. Miss even one payment by 30 days, and your score can drop 60 to 100 points in a single month. One slip. The second biggest piece, 30%, is something almost nobody understands, and it's the fastest lever you have. It's called credit utilization. This is the percentage of your available credit that you're actually using. If you have a $10,000 limit across your cards and you're carrying $3,000, your utilization is 30%. Here's the secret. Lenders want to see that number low. Under 30% is okay. Under 10% is where the magic happens. The average American runs their utilization near 30%, and it's quietly dragging their score down every month without them even knowing. Now stack those two together. Payment history and utilization make up 65% of your entire score. Two things, and both of them are completely in your control. The remaining 35% is smaller stuff. The length of your credit history, 15%, which is just how long your accounts have been open. Your credit mix, 10%, meaning whether you have different types of credit. And new credit, 10%, which dings you a little every time you apply for something new. But the headline is simple. If you only fix two things, on-time payments and low utilization, you've handled almost 2/3 of the entire game. Here's the part that feels like a genuine loophole, because it works faster than anything else. Utilization has no memory. Unlike a late payment that haunts you for years, your utilization resets every single month based on your latest statement. Pay your balances down below 10% and your score can jump 30 to 60 points within one billing cycle. By 1 month. That's the closest thing to a cheat code the credit system has, and the people who understand it use it right before they apply for a mortgage or a car loan to unlock a better rate. Meanwhile, there's a myth that refuses to die, that you need to carry a small balance to build credit. That is false. Carrying a balance just costs you interest and can hurt your utilization. Pay in full, keep utilization low, and you win on both sides. Now, let me show you why this number is worth real money, not just points on an app. Lenders don't read your exact score. They read it in bands. There are invisible cutoffs, and crossing one changes your entire financial life. Around 620 unlocks a normal mortgage. 670 unlocks the mainstream credit cards. 740 unlocks the best advertised rates. And 760 gets you the single lowest rate a lender offers. Here's why those lines are brutal. A person with a 668 and a person with a 672 feel identical, but one sits below the cutoff and one sits above it, and they get offered completely different interest rates for being 4 points apart. That's why nudging your score across the next line can be worth more than a raise at work. If this is opening your eyes even a little, do me a quick favor and subscribe. This channel breaks down the hidden machinery of money every week in plain language with nothing to sell you. Now let me show you the trap almost everyone falls into. Remember that $94,000 example from the beginning? Here's where it comes from. On a $400,000 mortgage, a borrower borrower with a score of 760 pays an interest rate that's about 1.5% lower than a borrower at 680. That gap, spread across 30 years, adds up to roughly $94,000 in extra interest. Same house, same loan. The person with the lower score is quietly handing the bank the price of a second house, purely because nobody ever taught them how a 3-digit number worked. That is the real cost of financial illiteracy, and it never shows up as a single dramatic bill. It bleeds out slowly, a little every month for decades. And here's the trap that catches even careful people. The score you see is usually not the score they use. Those free apps on your phone almost always show something called a Vantage score, but most lenders, especially mortgage lenders, pull a different number, a FICO score, and the two can differ by 20 to 40 points. So people walk into a bank feeling confident about the number on their app and get hit with a completely different reality. Knowing which score actually matters and checking it before you apply saves people from ugly surprises. There's one more quiet trap: closing an old credit card. It feels responsible, but it can actually hurt you because it shortens your credit history and shrinks your available credit, which spikes your utilization overnight. Sometimes the most responsible feeling move is the one that quietly costs you points. So let's step back and look at what this really is. Your credit score was never a measure of how good a person you are, or even how much money you make. A millionaire can have a terrible score, and a person earning modest wages can have a perfect one. The score doesn't measure wealth. It measures one thing: how reliably you handle borrowed money, according to a rule book nobody bothered to teach you in school. And that's actually good news, because it means this number isn't tied to your income or your background. It's tied to a handful of behaviors you can start controlling this month. Pay on time, every time. Keep your utilization under 10%. Don't close your oldest accounts. Check your real FICO score before any big application. Do those 4 things, and you can move a number that most people treat like a fixed sentence handed down at birth. So the next time you hear someone talk about their credit score in a hushed, nervous voice, like it's some mysterious force of nature, you'll know the truth. It's not magic, it's not luck. It's a game with published rules, and now you have the rule book that the banks quietly hoped you'd never read. The only question is whether you start playing it on purpose, or keep paying the $94,000 penalty for playing it blind. So tell me in the comments, did you know your utilization was quietly moving your score every month? And has anyone ever actually explained any of this to you before today? Because the person scrolling past this might be one late payment away from needing to hear it. And if this handed you a rule you didn't have before, the next step is understanding how the whole borrowing game works, so debt starts building your future instead of stealing it. This video is for education and entertainment only and is not financial advice. Always check your own credit reports and speak with a qualified professional about your specific situation.